I want to get an update on where we're expecting the market going, where it should go now, considering the fact that we've just completely moved by about 500 points here. The Dow now up again 0.5% after being down as much as 450 points. For more on that, we're bringing in Eddie Ghabour, Key Advisors Group. He's with Key Advisors Group and author of Common Sense Bull. And Eddie, when we look at this, it's interesting the moves that we're seeing today. It seems like a very intense battle for bulls and bears to be positioning here after that unemployment update we got. What's your take on the way that more and more people are starting to revise how bad things might get here on the employment front?
So look, you have two dynamics here. You've got Wall Street and Main Street. In regards to Main Street, we are witnessing the worst economic shock of our lifetime. And so it is my opinion that we are not going to see a V-shaped recovery economically. There's just too much collateral damage being done. There's certain sectors that jobs just aren't going to come back. So we're going to be living in a high unemployment number for quite a while. Now, on the flip side with Wall Street, as we well know, we do not need a strong economy to have a strong market. Now, we're still very cautious right now from a market perspective. We think this tug of war like today is a great example of this volatility. You're going to continue to see this until there's a little bit more clarity on when we're out of the woods. And we're not going to be out of the woods this year. The bottom line is, in our opinion, until there's a vaccine, we're going to have to learn how to deal with this virus. And business just is not going to go back to usual until we get there. And so this market is going to struggle to get above that 2950 mark on the S&P 500. And, you know, we're not out of the woods yet on possibly testing the lows we saw in March either. We think second quarter earnings are going to be worse than first quarter, and that's going to kind of set the table for how we finish the year.
Yeah, I mean, just when we think about expectations for how quickly this recovery happens here, it doesn't seem like optimism on that front is growing. We had heard about the possibility of a V-shaped recovery. More and more people may be positing it could be a U-shaped recovery, a swoosh-shaped recovery. When you look at the timeline there, it does seem like the timeline to close was far quicker than what we're expecting to see on more people going back to work, and even more importantly, consumers returning to businesses to start purchasing again.
Yeah, look, there's going to be behavioral changes because of this. Again, there's a lot of families that are going to be negatively impacted because of them losing their jobs. And the unfortunate reality, as I said, you know, just look at the restaurant space, for example. I mean, is it realistic for us to think that they're going to go over 50% capacity moving forward this year? You know, probably not if we're practicing the social distancing they're going to be required to do. So certain pockets of our economy are going to get hurt really bad, unfortunately. And those jobs and those consumers are not going to come back in that space. It's an unfortunate reality we're dealing with this horrific virus that we're dealing with right now.
Yeah, I mean, and just to return to your first point there about how you could have, you know, a strong market with a weaker underlying economy. I mean, what we're seeing right now is not just a weak economy, but a historically terrible one when you think at the underlying metrics. I mean, the unemployment rate, Goldman Sachs saying that it could peak at 25%. Their previous estimate was about 15% here. So when you do look to Q2, I mean, if this is to draw on longer and longer than what people were originally expecting, what do you think are the sectors to play into? Because right now, financials is clearly the strong player today. But when you're trying to invest over an extended time period, where are you looking for opportunity here if we could get back to normal past that trough?
So look, right now, I know financials are having a good day, but they're still down, you know, over 40% year to date. I think in this economy, that's probably one of the toughest businesses to succeed in. When you look at the yield curve, when you look at the hurting consumer, I think right now here in the interim, the same plays that have been strong, your stay-at-home economy plays, like the technology space, like the work from home space, are going to continue to be the leaders. I'm cautious right now jumping into anything at these current levels because, again, I think right now when you look at the upside potential versus the downside, I think there's limited upside here in the near term and potentially more downside because the Fed has been the biggest reason why we've seen this snapback. If the Fed did not jump in, what they do, we would be in a pretty ugly spot right now. So I think they're going to have to come out with even more stimulus before we get through this. And if we don't get that, I don't think the market's going to like it.
No, you raise a very good point there because we have seen the Fed come out, but even just yesterday when we heard Fed Chair Jay Powell speaking, it did sound like he was basically prompting Congress to be doing more on the fiscal stimulus side when we think about what can be done there. But when you look at Washington, D.C. right now, essentially gridlock between what the Democrats want to do and what Republicans are prepared to compromise on. So, I mean, we could not necessarily see anything past here till after Memorial Day. When you look at that timeline, it's a lot of time for the market to be waiting on what could happen here. So what's your take on what could happen if we don't necessarily see, if the Fed's kind of content with what they've been doing, if we don't see anything on the fiscal side?
If we don't see anything on the fiscal side, then that's going to be, again, it's going to be very bearish for the equity markets, because whether we like it or not, there's that much damage done economically right now that we need this stimulus for certain sectors to go move forward. And if we don't get it, again, the market's going to react in a very bad way, and I would expect to see a double-digit percentage drop. Now, I will say, when we see those double-digit percentage drops, I would buy those, in my opinion, those double-digit drops, because I think we're in an environment where you can buy the major dips and sell the major rips until we get through this year, and hopefully a year and a half, 2.5 years from now, you'll be rewarded for that risk that you took.
All right, there you go. Buy the dips, sell the rips, something, Lay's potato chips. Eddie Ghabour, appreciate you taking the time to chat with us, man. Always enjoy your insights.
Thank you. Have a good day. Stay safe.
You too.
Hey investors, Zack Guaman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.